So, Take-Two Interactive has delayed the release of Grand Theft Auto 6 to May 26th, 2026. Now, I last did a video on Take-Two Interactive a couple of months ago, and since this news came out, I thought it'd be a good time to revisit the company, evaluate the long-term risks, share with you my proprietary discounted cash flow valuation model, which calculates what I believe is a fair value for the business today, and update my recommendation and let you know if I think it's a buy, hold, or a sell right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So let's start with the risks. And the most obvious risk is the dependence on major game releases, right? We've been waiting for the Grand Theft Auto release, which was scheduled to release in the fall of 2025. And the news just recently came out that it's going to be delayed until May of 2026. GTA 6 is expected to be a major hit that's going to generate billions in revenue for the company. And it's just so reliant on these big hits to generate revenue for the company and profits for the company. So the company has also emphasized the importance of its core franchises, such as GTA and NBA 2K, which is also another popular franchise, for its future success. And there is no guarantee that the company will be able to continue updating these popular franchises in a way that consumers appreciate and pay money to purchase. Another risk is the integration and performance of acquisitions. The company merged with Zynga, which expanded Take-Two's mobile gaming portfolio because Grand Theft Auto and NBA 2K is more popular on gaming consoles, but Zynga is more popular on mobile devices. But it's not always the case where you make an acquisition and the acquisition pays off. In fact, it's usually the opposite. When companies make an acquisition, they usually overpay and the benefits don't add up to what was expected when the company made the acquisition. And finally, reputation and brand management is the last risk I'll highlight. The company has filed lawsuits against third-party marketplaces that are selling unauthorized in-game items, trying to protect the brand integrity. The community engagement, negative player feedback, and community dissatisfaction can impact sales and brand loyalty. Remains to be seen how upset players will be on this further delay for Grand Theft Auto. Players have been waiting so many years for Grand Theft Auto, and now it's delayed again from the fall to early next year. And if there's too much, if there's a lot of dissatisfaction, that could impact sales when the company actually launches the game early next year. All right, so now that we looked at the risks, let's look at the company's valuation. So I'm just going to focus on the output of my model here. This is a proprietary discounted cash flow model I created to value a share of a business today. The intrinsic value per share is the output. That's what I feel a stock is worth today. If you want a more detailed breakdown of these discounted cash flow models, I have dozens and dozens of member-exclusive videos. To join my channel, it's less than $5 a month. I think it's a no-brainer, a great deal. So the output here, the intrinsic value per share I calculated for Take-Two is $193. The current market price is $227. So according to my discounted cash flow model, the stock looks slightly overvalued according to its prospects in future years. Now, the prospects are good for the future in that it will generate strong free cash flow. The present value of all of the free cash flow I expect this business will generate between now and the very long run is $37 billion. That's a large number for a gaming company. Furthermore, there's positive trends in the gaming industry in that it no longer relies on discs to make game sales, which is a big positive for Take-Two Interactive and other game companies as well, because it adds value for the customer. They can get the game almost instantly through a download, and it also lowers cost for the business because they don't need to pay to manufacture the disc and the case and then distribute to stores like Walmart, Target, Best Buy. They can go direct to consumer through the PlayStation or Xbox console or other gaming consoles and services. And so that makes it more profitable and it adds value to customers. That's going to be a tailwind for Take Two for many years to come. I also like to look at valuation using the forward price to earnings ratio. And my preferred data source is finchat.io. There's a link in the description for a discount if you're interested. The forward price to earnings of Take Two is at 40, the highest it's been going back all the way to January. So the valuation is also stretched now, especially because the next 12 months earnings now don't look as good as they did a month ago when we were expecting the release of Grand Theft Auto in the fall of this year. So now that that's delayed, that's going to decrease the earnings prospects for those months where it's now pushed out to next year. So the earnings per share for between May of 2026 to May of 2027 look stronger, but the sales and profits between, let's say, the holiday season this year and May of 2026 now got diminished significantly because it will lack the release of that very popular game. So about a month ago, when I evaluated the business on April 10th, I told investors not to buy the stock. The business was overvalued then. Now, since they made the announcement, the stock price has declined and the earnings per share expectations have also declined. So the valuation hasn't improved, even though the price has come down because the earnings prospects have also come down. So to update this recommendation, I still don't think investors should buy this business just yet. I think the valuation is expecting a robust outcome from the game release. I don't think it's any secret that it's a very popular game, that it's going to generate strong revenue and profitability when it does come out, and that's incorporated into the valuation. So I don't see any reason why you need to get ahead of that and buy it today. So for that reason, I'm rating this stock as a hold for now.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.